I want to tell you something that might sound unexpected at first, something that goes against what most people believe about money and investing, something that could actually make you feel calmer and more confident about where you stand financially today. If you're someone with only a few $1,000s to invest, or even just a few hundred, you're not behind. In fact, you're in a position of strength. Being a small investor is not a disadvantage, it's an advantage, a powerful one. You have flexibility, freedom, and opportunity that very large investors simply don't have anymore. Most people assume the opposite. They think, if only I had the kind of money Warren Buffett has, then I'd be rich too. But that thinking is completely backward. When you control billions of dollars, your choices become narrow. You can only invest in very large companies. You can't move quickly. You can't take advantage of small, overlooked opportunities. Your size becomes a limitation. But when you're a small investor, you're agile. You can move freely. You can do things that massive investors cannot. And believe me, those advantages are incredibly valuable if you understand how to use those advantages properly. If you truly understand the core secret behind small investor success, you can build real, lasting wealth starting from almost nothing. And today, I want to share that secret with you. The strategy that works best for small investors, the approach that allows you to compete and succeed even when you're starting with limited capital. This isn't theory, this isn't speculation. This is based on decades upon decades of real investing experience. This is exactly what I would do if I were starting over today with $10,000 or even just $1,000. So let's begin with the secret itself. The one thing most small investors never fully understand. Your greatest advantage as a small investor is that you can invest in low-cost index funds and leave them alone for the long term. That's it. That's the secret. I know that probably sounds disappointing. You are likely expecting something more exciting. A stock-picking formula, a way to find the next Amazon before everyone else, a clever trick to beat the market. But that's not the answer. The real secret is simplicity. You don't need to be clever. You don't need to predict the future. You don't need to time the market. You simply need to buy low-cost index funds, hold them patiently, and allow compound interest to do what it has always done over time. Now, let me explain why this strategy is so powerful and why it works better for small investors than for almost anyone else. First, you need to understand what an index fund actually is. An index fund is a fund that owns all the companies within a specific market index. For example, an S&P 500 index fund owns shares in 500 of the largest publicly traded companies in the United States. A total stock market index fund owns nearly every public company in the country. When you buy an index fund, you're not betting on one company. You're buying a tiny piece of the entire economy. You're investing in innovation, productivity, and long-term economic growth. You're betting on the idea that businesses as a whole will continue to create value over time. Historically, that bet has paid off extraordinarily well. Over the long term, the U.S. stock market has returned around 10% per year on average. Some years are better, some years are worse. But over decades, that average holds remarkably steady. At a 10% return, your money roughly doubles every 7 years. In 14 years, it quadruples. In 21 years, it grows eightfold. Over 30 years, it can grow more than 15 times. That's how small amounts turn into meaningful wealth. That's how patience beats brilliance. Now, here's why this approach works especially well for small investors like you. You have three major advantages that large investors simply don't have. Advantage number one, you can stay fully invested. When you manage billions of dollars, you can't invest every dollar into the stock market. You need liquidity. You need large amounts of cash available at all times in case opportunities arise. That cash earns very little, but it's necessary. As a small investor, you don't have that problem. If you have $10,000 or $100,000, you can put every dollar to work. You don't need to hold billions in cash waiting for opportunities. You can be fully invested, earning returns on every single dollar. That's a massive advantage. Large investors are forced to accept lower overall returns because so much of their money sits idle. You don't have to. Every dollar you invest can compound over time. Advantage number two, you can achieve instant diversification at almost no cost. With a single index fund, you can own hundreds or even thousands of companies across every sector of the economy. Technology, healthcare, finance, energy, consumer goods. You own them all, and the cost is incredibly low. Some index funds charge just a few hundredths of a percent per year on a $10,000 investment. That might be only a few dollars annually. That's remarkable. When large investors invest, they must analyze individual companies in depth. They spend enormous time and resources studying financial statements, meeting management teams, and evaluating competitive advantages. Even then, they often end up concentrated in just a few positions. You, on the other hand, can own the entire market instantly, cheaply, and effortlessly. That level of diversification is an extraordinary advantage, and one that didn't even exist for most individual investors decades ago. Advantage. Number 3, tax-efficient compounding. Every time you sell an investment for a profit, you trigger taxes. Those taxes reduce the amount of money you have left to reinvest. Over time, that tax drag can significantly reduce your returns. But when you buy index funds and hold them for decades, you defer taxes for a very long time. That means more of your money stays invested and continues compounding. The difference between paying taxes along the way and deferring them until the end is enormous. This is one of the reasons long-term investing is so powerful. Compounding works best when it's uninterrupted. Index funds allow you to let your money grow quietly in the background for decades. So those are your 3 key advantages. As a small investor, you can stay fully invested. You get broad diversification at minimal cost. You benefit from long-term tax-efficient compounding. Now let's look at what this means in real life. Imagine you're 30 years old. You start with $10,000 invested in a broad market index fund. Then you contribute $500 per month, $6,000 per year for the next 35 years. Assuming long-term average returns, by the time you reach retirement age, you could have over $2 million. And that wealth comes not from brilliance or luck, but from consistency and patience. No stock picking, no market timing, no complex strategies, just steady investing over time. Some people ask, if this strategy is so effective, why do successful investors pick individual stocks? It's a fair question. The answer is simple. Professional investors devote their entire lives to analyzing businesses. They have decades of experience, teams of analysts, and access to information most people don't have. Even then, many of them fail to outperform the market consistently. Most people don't have the time, interest, or resources to compete at that level. They have careers, families, and responsibilities outside investing. For them, trying to pick stocks is competing against professionals without the same tools. That's usually a losing game. Index funds remove that competition entirely. You don't need to outsmart anyone. You simply participate in the market's long-term growth. In fact, over long periods, simple index strategies have beaten many professional investors once fees and taxes are considered. Complexity often works against returns. Simplicity protects them. If I were starting today as a small investor, here's exactly what I would do. First, I'd open an account with a reputable brokerage firm. Second, I'd build a simple portfolio, the majority in a total U.S. stock market index fund, a portion in an international stock market index fund, a small portion in a broad bond index fund for stability. That's it. 3 funds, simple, diversified, and low cost. Third, I'd automate my investments. I'd set up monthly contributions so money is invested regularly without requiring constant decisions. Automation removes emotion from the process. Fourth, I'd avoid checking my account frequently. The more often you look, the more likely you are to react emotionally to short-term fluctuations. Long-term success requires ignoring short-term noise. Fifth, once a year, I'd rebalance the portfolio to maintain the original allocation. That disciplined process forces you to sell what has grown the most and buy what has lagged automatically, encouraging buy low, sell H behavior. And finally, I would not sell unless absolutely necessary decades later. That S, the entire plan. The biggest threat to small investors isn't lack of money or intelligence. It's behavior, emotional decisions, chasing trends, panicking during downturns, overtrading. Index investing reduces those mistakes by design. Yes, markets will crash. That's unavoidable. But crashes are temporary. History shows that markets recover and grow over time. Investors who succeed are the ones who stay invested during uncomfortable periods. Investing isn't supposed to be exciting. Excitement often leads to poor decisions. Wealth is built slowly, quietly, and patiently. If you want excitement, find it elsewhere. Let your investments be boring. You don't need a large starting amount. You don't need special knowledge. You just need to start and stay consistent. There's a clear difference between investing and gambling. Speculation seeks quick wins. Investing focuses on long-term growth. Index funds represent real investing. If you commit to this simple approach, investing regularly, holding patiently, ignoring noise, you will build wealth. Not because you're smarter than others, but because you avoided unnecessary mistakes. That's the real secret. Simple beats complex. Consistent beats clever. Boring beats emotional. Buy index funds. Invest automatically. Hold for the long term. Let time do the heavy lifting. That's how small investors win.